Hi, hello, namaste to all of you. Welcome to Financial Management MCQ live series. Are we live? Can you hear me properly? Is my video clear to you? Can I get a quick reply in the chat box? Everybody, can I get a quick reply in the chat box? Is my audio clear to you? Is my video clear to you? Yes. All right, perfect. Good evening to everybody in the chat box. Yes. Are we good to start then? Yesterday, I think in the previous session, we have completed cost of capital 25 MCQs. Am I correct? 25 MCQs. Is that correct? Then we have to start from 26th today. Yes. I'm reading your messages in the chat box. To all those who joined now, hi, good evening, welcome. And those who are watching from this session, let me tell you a few basic things before you continue watching this session. All these questions that I'm discussing using PPT, PowerPoint presentation, will be shared with you on the last day of this series. We will be doing 5 days of FMMCQ discussion series. We are done with 2 days. Today is our third day. Cost of capital. Today our plan is to complete dividend decision and capital structure, and tomorrow working capital management, and after that I'll be doing ratio analysis and types of financing, the last theory topic. Once all the MCQs are done, I'll be sharing all this PPTs with you via Google Drive link, and it will be free. All of you will be able to download it once all 5 sessions are done. Okay. And also one more thing, if you're watching from this session, keep one thing in mind. I want you to keep a notebook, a pen and calculator next to you. We will also be doing some practical MCQs for which I want you to work out the sum and send the answers, and I'll be discussing that once you send your answers. Okay, so let's continue. Question number 26. Everybody? Yes. I want you to send the answer in the chat box. Question number first, and then the answer according to you. Market value of retained earnings. Read it properly. It says market value, but it says market value of retained earnings. Okay. Will be shown in WSEC market value table, not shown separately in WSEC table, added to market value of debentures, taken as market value of equity shares. Which is the correct answer? First of all, is there any market value for retained earnings? Value will be there only if the item can be bought and sold. Am I correct? Retained earnings can never be bought and sold. Please slow those who are sending the answers to me. Retained earnings cannot be bought and sold. That retained earnings, everybody take your time, think and answer. Right, guys, I think there was a small lag. I have fixed it now. I hope it is completely fine. The correct answer is B. It will not be shown separately in WACC market value. Understand, the reserve has some power, correct? Because whoever is going to be the future owner of that share will enjoy the benefit of the reserve. Therefore, that market value of the reserve, there is no market value. Though I am saying this in sentence, in reality there is no market value for reserves and surplus. That will be included or hidden in the market price of equity share itself. Therefore, you do not have to worry about showing market value for reserves and surplus separately. Therefore, the correct answer is it is not shown separately in WACC table at all. It is not shown separately in WACC table at all. Yes, let's move on. Question number 27. WACC is calculated after assigning different weights to the components according to the proportion of the component in the capital structure. Answer is true. That's how you calculate WACC, correct? What is WACC? No, don't give me long form. What is WACC? Sir, each item in my capital structure has its own cost, correct? And it has the amount, it has that weightage also. So when I assign the weightage based on the amount and multiply that by cost, what I get is weighted average cost. Therefore, the statement is true. Simple sentence. Question 28. The firm is not required to pay dividend on retained earnings, so it may be argued that the retained earnings have no cost as such. This is false. Very important. If I take money from equity shareholders in the form of equity share capital, I have to pay some dividend, correct? But if I use their reserves and surplus, I don't have to pay dividend, agreed. But does that mean reserves and surplus is a free source of capital? Answer is no. It cannot be a free source of capital. Why it cannot be a free source of capital? Please understand that equity shareholder, I'm sorry, I think I opened a wrong slide. Just a second. Yes, here we are. Understand that equity shareholder, he is the real owner of reserves and surplus, correct? Therefore, he will be expecting some return on that money also. Think, process this properly. A company has earned EPS of 7 rupee, 7 rupee EPS, and in the annual general meeting, they convinced their shareholders. They convinced their shareholders that we will not give you dividend this time. We will keep all this money as reserve. Yeah, shareholders agreed also. Now tell me, shareholder is aware that 7 rupee was supposed to be given to him in the same financial year in the form of dividend, but company did not give. Therefore, he'll be expecting some return in future, not only from his equity share capital, even from that reserve portion. Because if he had given 100 rupee for share capital, he has his 7 rupee in company's bank account now in the form of reserves and surplus. So he'll be expecting return not from 100, he'll be expecting return from 107. Correct? Therefore, we cannot say reserves and surplus have got no cost. There is some cost. Whatever is the cost of equity, normally we can consider that itself as cost of reserves and surplus also. Yes, perfect. Question number 29. NM Limited is currently financed with 1 lakh rupees of 7% bond. Remember, bond is a debt instrument, and 2 lakh rupee common stock. Common stock means equity shares. The stock has a beta of 1.5. Risk-free rate is 4%. Market premium is 3.5. The tax rate for company AKL size is 35%. Answer the below. First question is ratio of debt to capital employed. Question is debt to capital employed. How to do? Debt divided by total capital. How much is debt? First one, bond, 1 lakh rupee. Correct? Bond is a debt instrument. 1 lakh rupee divided by total capital. When I say total capital, I have to count 1 lakh plus 2 lakh, bond plus equity, total 3 lakh. So 1 lakh by 3 lakh will be what? 1 by 3. Therefore, the correct ratio will be 1 divided by 3. Hope you are following. 1 divided by 3. Yes. Same data. NM Limited is currently financed with 1 lakh rupees of 7% bond, 2 lakh rupee common stock. Stock has a beta 1.5, risk-free rate 4%, market premium 3.5%. Tax rate is also given. How much is cost of equity? How much is cost of equity? Here you have beta with you have risk premium with you, correct? That means you have to use CAPM formula. Correct? In CAPM formula, what do I need? First, RF 4% plus beta 1.5 into market risk premium already given. What is the meaning of market risk premium? RM minus RF. RM minus RF. That means you can directly take 3.5 in the bracket. That means my formula will be something like this: 4 plus 1.5 into 3.5. I think you get final answer as 9.25. Please check, is it 9.25 or 9.5? Please check. Option A or B? Option A. I repeat, 4 plus 1.5 into 3.5. When you do 1.5 into 3.5 and then add this full 4%, I think 9.25 is the final answer. Yeah? Yes, sir. Let's move on. Question 31. Same data again. NM Limited currently financed with 1 lakh bond, 2 lakh common stock. There is an extra 0. Sorry, it is just 2 lakh common stock. Stock has a beta of 1.5, risk-free 4%, market premium 3.5, tax rate given. Weighted average cost of capital, WACC. How to do? WACC can be also written as KO. Correct? Yes or no? Now, how many sources you have? Weight of debt, cost of debt. This is first. Plus you have weight of equity, cost of equity, weight of equity, cost of equity. How to do? Weight of debt. You already did this. 1 lakh by 3 lakh. 1 by 3. So I will take this as 0.33. Understand, if weight of debt is 0.33, weight of equity should be 0.66. 0.66. Am I correct? To be multiplied by cost of debt. How much is cost of debt? Sir, 7% interest we pay. Correct. But there is 35% tax. So you can't take 7. You have to do 7 into 1 minus 0.35. Everybody, 7 into 1 minus 0.35. That will give you your KD. And cost of equity, just now you told me in the previous question, 9.25%. Therefore, then when you add 0.33 into KD plus 0.66 into KE, I think the final answer comes to 7.67. I will wait. Take your time and tell me final answer whether it is correct or not. Yes, I can see a lot of them have 31D in the answer. Yeah, perfect. All good. Can I continue? Yes. Question 32. If the weights are ascertained in proportion of face value, then it is called book value weightage. Very simple. Market value weightage will be when you take market price of debenture, market price of preference share, market price of equity share. Correct? Book value, when you say, you are talking about balance sheet figures. Balance sheet figures are always at cost, historical cost, face value. Yes, sir. 33. Weighted average cost of capital represents an average cost of all sources of the company and can be used to evaluate investment decision. 100% true. What do you mean by this? can be used for investment decision if my WACC is 8%. That means my overall fund is coming at 8%. I should invest only in those places where I can earn more than 8%. That means all my investment decisions are based on WACC. Correct? And I should never invest. If my WACC is 8%, I should never invest in a place where I'm getting 7.5%. I'll be under loss. Yeah. All right. Question 34. KPL Limited keeps fixed amount of debt in its book. It pays coupon rate, means interest rate, 15%. Its debt sells at par in the market. Firm pays 35% tax. What is the cost of debt if it sells at 5% premium? Understand, your numerator will be face value into rate of interest, but your denominator will not be face value, but you are issuing it at premium. You have to take face value plus premium. Sir, everything is okay, but where is the amount? Now understand, if you don't have amount, 15%, you can take 100 as the base. Therefore my interest will be 15 rupee. Assuming 100 as the base. In exam, if you don't know, take 100, take 10, take 1000, take any number. Anyway, you will be applying percentage. What's the problem? 15 into 1 minus tax, and tax is 0.35. 15 into 1 minus 0.35 divided by, since I have taken base as 100, but there is a premium of 5%, I will take it as 105. So 15 into 1 minus 0.35 divided by 105 into 100, because you want the answer in percentage. 9.2%, 9.2% to 8%. Is that correct? Question 34, how many of you can answer? A. Good. Yes. Perfect. Yes, sir. Let's move on. Can I? Question 35. KPL Limited keeps fixed amount of debt. It pays coupon rate 15%. Debt is sold at par in the market. Firm is paying 35% tax. What will be the cost of debt if they start issuing, selling the debt, selling the bond means issuing the bond at 5% discount on face value? Remember, now it is discount, you're not going to get 100. Again, base value is not given, I'm taking it as 100. So 15 into 1 minus 0.35, this will now be divided by 95. Are you with me? This is 95, because if face value is 100, then 5% discount on that will bring it down to 95. What if there is flotation cost of 3 rupee? Even that you have to minus. You can't take 95, it will be 95 minus the flotation cost also. Yeah. Sir, in none of these questions, 34, 35, none of these questions were thinking about redeemable value. Correct? There is no data. What can I assume? 5 years, 10 years, 15 years, redeemed at par, premium, discount. How will I know? Unless they mention in the question that it will be redeemed after 5, 10, 15 years, I can't make any assumption. Correct? And also read the first line of the question. They gave a hint saying what? KPL Limited keeps a fixed amount of debt in books. That means any year you prepare balance sheet, there is always the debt. That means you're never going to redeem the debt. You will perpetually, forever, you will have the debt. Even if you redeem old debt, you will issue one more debt. Therefore, forever you will have the debt in your capital structure. Therefore, I don't have to worry whether it is redeemed after 3 years, 5 years, 8 years, 10 years. If they give, I'll take. If they don't give, don't assume some 5, 10, 15 random years. That will be wrong. Question 36. ABC Limited has issued 14% perpetual preference share. That means forever you have to pay. And this is preference share. That means you have to pay dividend. The current price of the preference share is 100. What would be the cost of preference share if the share is issued at 90 rupee, assuming 30% tax? Now tell me, you are talking about preference share. Therefore, this tax information is only to confuse you. It is of no use. Tax is not relevant when you're doing equity dividend or preference dividend. All that matters is only, correct, when it is debenture. Correct? Tax matters only when it is debenture. Preference share or equity share, you don't have to worry about tax treatment. Yeah. Perfect, sir. Therefore, what will be the answer? Numerator is 14. There is no into 1 minus t. I know I am repeating this. I've already repeated this. many times, but it's extremely important. Students mug up this formula, I into 1 minus t. For preference dividend also they do p into 1 minus d. P into 1 minus t, wrong. When you are talking about dividend, preference or equity, where is the question of tax? Yeah, to be divided by issued at 90 rupee. So it is simply 14 by 90, I think 15.5%, option A. Everybody, option A. Yes, sir. Good. I can see many of them have sent the answer. Let's move on. Question 37. Similar data, 14% preference share, 100 rupee. Current price is 100. What will be the cost of preference share if it is issued at 120 rupee? That means premium. But understand, you will pay only 14 rupee dividend. That won't change. 14 divided by 120. I think I get 11.67%, option A. Am I correct? Am I correct? 14 divided by 120, 11.67%. Most of them have sent the answer, same answer. Hello, good. Which of the following statement is correct? Read slowly, very slow. Cost of debt is normally higher than cost of equity. They are saying KD in most of the cases will be more than KE. Cost of debt is equal to cost of equity. KD is equal to KE. Forget formulas, understand logically. Cost of debt is lower, that means KD is cheap, KE is high. And last option, there is no tax benefit due to debt. Sir, this is right away wrong statement. Between A, B, C, you think now. They are saying cost of debt is higher or lower or equal. Think, if somebody has invested in debt, that person, the investor, has taken low risk, because debt will get interest before the equity shareholders, correct? If an investor, think from his angle, if an investor has purchased a debenture of ABC Limited versus another person has purchased equity shares of that same company ABC Limited, equity shareholder is taking more risk than debenture holder, correct? Now when debenture holder is taking less risk, because he is taking less risk, the return that he would expect will also be less. Now return from his point of view will be cost from company's point of view. Therefore debt is cheaper. Debt is cheaper. That means KD should be less than KE. KD should be less than KE. Cost of debt is lower than cost of equity. Option C is the correct answer. Debt is cheaper, equity is costly. Practically also, when you solve the sum, remember in exam, if there is a 5 marks detailed sum, computation of WACC book value, I have told this in my regular batches also repeatedly. When you work out KE working note 1, KP working note 2, KD working note 3, when you do, check before you do the table. If cost of equity is 25%, cost of equity 25%, and if you get cost of debt KD as some 28%, 31%, recheck. Somewhere something is wrong, because debt is always cheaper than equity. Yeah, 99.9% of the questions, if you check, debt is cheaper, equity is higher, correct? And on top of this risk factor, understand from company's point of view, when they pay some interest, they also save some taxes. First of all, debenture investor is expecting less, so you can pay less. In that less also, when you pay, you will save some taxes. That means there is a double advantage. Investor is expecting less return, so it becomes cheap. Whatever you pay, on that you save 30%. That means it is much cheaper now. So debt has to be cheaper than equity. Therefore, KD should be less than KE. Yeah, keep this in mind while doing detailed sums, also descriptive type. Yes, go ahead. Question 39. Delimited common stock. Common stock means equity shares, has a beta of 1.2. The risk-free rate is 6%. Market return 11%. Find out cost of common equity using CAPM. What is the formula? KE is equal to, sir, I need first RF, risk-free rate, and that is given as 6% plus beta 1.2. I don't think you need my help in this. 1.2 into RM minus RF. And how much will be RM minus RF? 11 minus 6. Am I correct? 11 minus 6. What is the final answer? 12%? 9%? Yes, sir. So, question 40. ABC Limited has expected earnings at the end of the year rupees 30 per share, which is growing at 8% annually. Company follows fixed payout ratio of 50%. Market price of its share is 300 rupee. Find current cost of equity using dividend growth model. When they say dividend growth model, it is not D by P, it is D1 by P0 plus G. D1. Be careful. Some of you will do mistake here. D1, how to calculate? D1 is not today's money. D1 is money after 1 year. Sir, 30 rupees is the earning given in first line. And then second line says company follows fixed payout ratio of 50%. That means 13 to 50%. 15 rupee will be dividend. But please read properly. Should I apply growth? Today also some students have messaged me. Sir, I have one doubt. What is the doubt? Sir, when to add G, when not to add G in the numerator. Some places we have not added G in the numerator. What do I mean by numerator? The D1 by P0, when you do the D1, I'm not talking about plus G separately. Guys, I hope you know this properly. D1 by P0 plus G we do. This plus G everybody understands properly. This plus G no one has a complaint. But this D1, sir, how to calculate? Read properly. D1, dividend at the end of the year. If you read the question, ABC Limited expected earning at the end of the year is 30. This number is already end of the year. That means this is already giving you earning at the end of year 1. This is EPS at the end of year 1. On this, don't apply G. So your numerator will be 30 and dividend is 50%. That means 15 rupee. 15 rupee, that will already be D1. Imagine the question. The line is like this. I'm just changing. ABC Limited has present earnings of 30 rupee. Now, if they say present earning 30 rupee, then it is earning as of now. On that, if you apply 50%, it will be 50% is 50. 50%, that will be D0. Then you have to add 8% growth to get D1. But in this question, you don't have to do any growth calculation. Therefore, what is the simple thumb rule? Many students have confusion in this. Sir, for D1, when to add G, when not to add G. Read properly in the question. Possibility number 1. Question itself says, dividend as of now, earning as of now, current dividend, present dividend, today's dividend, historically and even current year company is paying 3 rupee dividend. All of this means D0 and your formula says D1. That means for D0 you have to add G. But if question itself says expected dividend at the end of the year, dividend planned, that means they're talking about future tense. And when they're talking about future tense, it's already D1. You don't have to do anything. Copy that number as it is. Can I get a reply in chat box from everybody? Is this clear to you? I need a reply. This is most common doubt. I need a reply. Did you understand this properly? Everybody? Yes. Good. I'm reading your replies. Have you understood properly? You just have to read the wordings. You will get the clarity. If question says expected, future, planned, that means they're talking about next year. Correct? If question says currently, at present, as of now, for the given year, historically and currently, that means they're talking about D0. Yes, here read the question once again. ABC Limited has expected earnings. Expected means not today. Yeah, expected earnings at the end of the year. That means this number is already at the end of the year. Now you should not do any G calculation. Yes, sir. So now 13 to 15, 50%, numerator will be 1.5, and current market price, they are saying 300 rupee. Anyway, this plus G we have to do without any confusion. No one has confusion about this plus G separately. Confusion is only in that numerator D1 what to do. I hope this is sorted out now. So the final answer comes to 13%. Yes, perfect. Can I continue? Question 41. I want you to try this. Question 41, I've made a slight change compared to question 40. Read, ABC Limited has expected earning of rupee 30 per share. Now again, expected, that is not today. Expected means 1 year later, which is growing at 8%. Company follows fixed payout ratio. Market price of the share is 300. Till this is all same. Find out cost of the new equity if the firm issues fresh shares at current market price but with flotation cost of 5%. That means our numerator is same 15, but denominator will not be 300. It will be 300 minus 5%. That means it is 285 plus the growth rate of 0.08. Who can answer? Is it coming to 13.2%? Is it coming to 13.2%? I'm waiting. Option A, everybody. Yeah, good, good. Let's move on. Question 42. J Limited has its shares quoted in the market for several years. Its beta is 1.3. The yield on T bills. T bills, what does it mean? Treasury bills. Treasury bill, when I say, I'm talking about government bills, government bonds, risk free. Yes, 5%. Sometimes they say T bills, sometimes they say GOI, Government of India bonds. Yeah, sometimes they say treasury bonds, T bonds, all of that is same. At 5%, market return is expected to be 15%. What is market return expected to be 15%? This is your RM in the CAPM formula. Find out cost of equity for J Limited. Question is about KE using CAPM. So your answer will be something like this: 5 plus 1.3 open bracket 15 minus 5. 15 minus 5 will be 10. 10 into 1.3, that will be 13. 13 plus 5, 18% is the answer. Yes, I can see a lot of them have sent the answer. Yes, sir. Good. Question 43. A firm has a target capital structure of 50% common stock. Common stock means equity share. 5% preferred stock, that means preference share. 45% debt. Its cost of equity is 16%, cost of preference share 7.5%, cost of debt is 9%, relevant tax rate is given. What is its WACC? Detailed question. They want you to do WACC for MCQ. Sir, what is this? I have to do so much of calculation. Correct. Common stock means equity share capital. Preference share is preference share capital. Debt is here. You don't need amount. Anyway, weights are given. Correct. 50%, 0.5, 5%, 0.05, and 45%, 0.45. If you can recall, the total of the weights should always be equal to 1. 0.5, 0.05, 0.45. This should be multiplied with respective costs. Where is respective cost? Equity 16%, preference share 7.5, but debt before I take, it is not 9, it is 9%, and then there is tax. That means I'm supposed to do I into 1 minus t. So 9 into 1 minus 0.35. I am checking in my calci, I am getting 5.85. 5.85. And now if I do weight into cost. Weight into cost. I get 3 numbers. The total of the 3 is what they are asking. I think we get 11.01%, 0.5 into 16, 0.05 into 7.5, 0.45 into 5.85. Can I get a reply in chat box? Good, 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 good. Many have sent 43A. Very good. If this is your speed in exam, you'll be able to comfortably complete full 100 marks in 3 hours. Because you know WSCC table is normally a descriptive type question. Yeah, but if you can do that also in good speed, I am happy. Yeah, very good. All those who did it so quickly, thumbs up from my side also. Yes, chalo, very good. 44. Now look at this. Following are the details regarding capital structure of a company: debenture, preference share capital, equity capital, retained earnings. Book values given, market value given, specific cost. Specific cost means for debenture 5% KD, preference share KP, equity KE, and retained earnings KR. Yes. Calculate weighted average cost of capital using book value as weight. 4 options are given to you. Now, book value amounts are there. You have to assign the weightage and then multiply by specific cost. A student has asked a doubt about previous question. I will answer in a minute. Yeah, no problem. Others, try this sum. They want you to do book value weightage. So don't worry about the market value data. 80,000 by 2,60,000, that will give you weight of debt. That into 5%. 20,000 by 2,60,000 into 8. Same way for equity. And when you are doing book value, remember KE and KR both to be taken, because reserves and surplus, there may not be market value, but there is always book value. You show reserves and surplus in balance sheet, correct? That means there is book value, no confusion. Yes. And then you multiply by individual cost. Many are sending me answer as option B, 9.54. Very good. Very, very good. Yes, you did it in good speed actually. Now, one doubt is, sir, last question, 43rd question, they said cost of debt. How do I get to know in exam whether it is pre-tax or post-tax? See, if tax rate is also given in the question, that means they want you to minus that t, I into 1 minus t. Imagine tax rate is not given in the question. Then they say cost of debt is 7%. Then you can assume that they have done the tax adjustment already. You don't have to do the tax adjustment. Correct? But in the previous question, in 43rd question, I'll just go to that. Here you see, they say cost of debt is 9%. Immediately they said relevant tax rate is 35%. Therefore, I should go by the understanding that tax is not adjusted. Yeah, if it is a descriptive question, we can give a note. But if it is MCQ, then we don't have a choice to give note. Correct? So if tax rate is given, then you assume the question data as pre-tax, you minus the tax. Yeah. If tax is not given, then you should assume that it is post-tax. Then you don't have to do anything. I hope I clarified the doubt. The student who asked that doubt, I think a lot of messages have come in the chat box. I do not know the name of that student now. Sorry. Did you understand? Yeah. Yes. Hello. So final answer, 44th question is 9.54%. Most of them have sent the answer. Very good. Question 45. Cost of equity is normally more than cost of debt. More than cost of debt. Correct? Option A is the correct answer. Next, 46. When investor increases their expectation from company, cost of capital will rise simultaneously. Answer is true. 100% true. Those who have doubt, investor is increasing the expectation. What does it mean? If I'm an investor, I want more return. More return to me means what? High cost to the company. More return to me means high cost to the company. Therefore, cost of capital will surely go up. Yeah, it's a true sentence. 47. When interest rate increases, cost of debt will increase, which will increase the cost of capital. Perfect. True. If interest rate goes up, I in my formula, I into 1 minus t, imagine I goes up. If I goes up, KD will go up. If KD goes up, overall cost of capital will go up. Yes. With this, we are done with our cost of capital. We did 47 questions. Yes. Fantastic. Can we start our next topic? Everybody, can I start the next topic? Yes, sir. Decision or dividend policy is our next topic. Let me start. This is the smallest topic. And please do not leave this topic and go. One day before exam. Risk and leverage and dividend policy. You should revise fast. These are very small topics. These are very small topics. Easy also, small also. Why to leave? Yes. One doubt in the chat box. Sir, when to use appropriation method and when to use YTM method in case of KD and KP? Look, if question is silent, then you go by appropriation. Appropriation is nothing but your formula method. When question is silent, you go by that. But if question says YTM method, then you have to follow YTM method only. No choice. So by default, you go by appropriation method. Appropriation is nothing but your formula method. Yeah. All right. Can I continue? Everybody. Yes. Before I start with dividend decision, first question, I want to repeat this once again. One day before exam, dividend decision and risk and leverage, you should revise first. Smallest two topics, easiest topics. Smallest and easiest and most suitable for MCQ. Most suitable for MCQ. Because if you know this Walter model, Gordon model, correct, they can just give some R, some K and ask you to work out at 80% dividend payout ratio how much will be the price of the share. Very suitable for MCQ style, correct? Therefore, please don't ignore these two topics, risk and leverage and dividend decision. Yes, hello, let's begin. Sumed, what is the difference between YTM and realized yield? There is no difference. YTM is realized yield method itself. YTM long form is yield to maturity. YTM we normally study in cost of debt. That realized yield that you said, we use it for equity. But both use same concept of trial and error. Yeah, more like the IRR learning that we have. Yes, sir. Question number 1, dividend decision. Let me start. Dividend is part of dash which is paid to the shareholders. EBIT no, EBT no, EAT is the correct answer. Because first from EBIT you have to pay interest, you get EBT, you have to pay taxes, you get EAT. In that there is dividend. First you pay preference dividend and then you pay equity dividend. Question number 2. There is no stipulation in the legislation about dividend policy of an organization. 100% true. No section in company law says you have to pay this much of dividend. There is no legal binding. There is no rule, there is no legislation, there is no law which says you have to pay some amount as dividend. Correct? So question 2, correct answer is A. Question 3, dash dividend means dash retained earnings and vice versa. High dividend means less retained earnings and vice versa. Which is the correct option? Option C. Yes, sir. High dividend. If you keep if you pay high dividend, then you'll be keeping very less reserve with you. And vice versa. Low dividend means high reserve. Yes, sir. Dividend constitutes dash that accrues to equity shareholder. Dividend is what? Benefit to them, profits to them, cash flow to them. None of the above. It's the cash flow. Why cash flow? When I say dividend, money will go from company's bank account to shareholders' bank account. It's a cash moving from one pocket to another pocket. Therefore, it has to be cash flow that goes to equity shareholders. Sir, benefit is also not a wrong answer, sir. Profit is also not a wrong answer. Think for a minute. Benefit, profits can also be said as correct answer. But then you can call EPS as the profit attributable to them, earnings attributable to them, benefits attributable to them. But just because you have EPS, that doesn't mean there is some cash transfer happening. Cash transfer will happen only if you pay dividend. That means the correct answer, most appropriate answer should be cash flow. Yeah, right, sir. Question number 5. Under regular dividend policy, investors get dividend at usual rate. This was the initial theoretical discussion in my regular class. If you can recall, regular dividend policy, shareholders get dividend at usual rate. Yes, sir. Question 6. Constant dividend per share, constant payout ratio, stable rupee plus extra dividend. All of this will fall under the category of stable dividend policy. Correct? Yes. 6. Option A. Question number 6 is option A. Constant dividend, that is 3 rupee, 3 rupee, 3 rupee every year. Constant payout ratio, 50% of EPS. Whatever is the EPS, 50% of that we will pay. Stable rupee plus some extra dividend. That means minimum 3 rupee you will get, plus I may give you 30 paise, I may give you 40 paise, I may give you 1.5 rupee also, but that I am not promising. 3 I am promising. All of this come under option A, stable dividend policy. Yes, sir. Question 7. When there is a payment of dividend depending on fixed percentage of earnings every year, it is called as constant payout ratio. Be careful here. Don't say constant dividend. If I say constant dividend, then 3 rupee should be constant. Correct? EPS may be 5, EPS may be 7, EPS may be 21. 3 rupee should be constant. But here they say fixed percentage. Fixed percentage means what? Say 50%. Whatever is the EPS, 50% will be paid. 80 rupee EPS, 50% of that. 8 rupee EPS, 50% of that. Correct? Question is talking about percentage. That means correct answer is option B. Yes, sir. Question number 8. Under which policy reserve fund is created to pay fixed amount of dividend in the year when the earning of the company is not enough? Regular dividend, constant payout, both A and B, constant dividend per share. Option D is the correct answer. If you observe the sentence properly, you will get to know you create a reserve fund. Why do you have to create a reserve fund? Understand, you want to pay 3 rupee dividend every year. Sir, every year my EPS may not be above 3, EPS may not be equal to 3. What to do? What to do? The best answer is, if you have an EPS of 7 rupee this year and you are paying only 3 rupee, that 4 rupee you keep it in a reserve fund. Next year, if your EPS is only 2 rupee, then you have some reserve, use that and still continue to pay 3 rupee. That means in future, if you want to pay same 3 rupee, 3 rupee, 3 rupee every year, in the year in which you have extra amount, you create a reserve and keep it ready. You create a reserve and keep it ready. I hope everybody understood this. Yeah. Question number 9. Business cycle, boom, depression, all of this will affect dividend decision. Answer is true. Answer is true. Now don't get this doubt. Are we talking about preference dividend or equity dividend? For preference dividend, we don't have this topic at all. Because we have promised them 8% dividend. What is there to discuss now? We have to pay them 8%. Am I correct? Am I correct? But equity dividend number may fluctuate because of business cycle, recession, depression, high inflation, low profits, tight competition, all of that. That will affect only equity shareholders. Yes, sir. Dividend is proposed by dash and approved by dash. Who will propose the dividend? Board of directors. Who will approve the dividend? Shareholders. Option C is the correct answer. Some students have this wrong understanding. Board of directors will decide how much should be the dividend. No, 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 they cannot decide. They can propose a number. All board of directors, imagine a meeting is going on. They can discuss among themselves and say, let's propose 25% in AGM. In AGM, the shareholders should pass the resolution. Then only this will become a reality. Correct? BOD can only propose, shareholders should approve. Final decision is with shareholders, keep that in mind. Yes, sir. Question 11. Relevance of dividend theory covers Walter, Gordon, both A and B. That irrelevancy model is only MM approach, MM theory. Only that is irrelevancy. Walter and Gordon both are relevancy theories. Option C, both A and B is the correct answer. Yes, sir. Question 12. If the choice of the dividend policy affects the value of the firm, it is considered as relevant. 100% true. Read, choice of dividend policy will affect the value of the firm. That means depending upon dividend, your share prices are either going up or coming down. And when share prices go up or come down, value of the shares and value of the business will also go up and down. That means your dividend policy has a connection to value of the firm. If one is connected to the other, they are called relevant. One is related, one is dependent. That means answer is true. Yeah. Yes, sir. Question 13. According to Walter's model, there is a relationship between dividend policy and common stock price. Please understand, common stock means equity. I have told you this many times. In MCQ series itself, I told you. Common stock means equity share, and that has a direct connection to dividend policy. Right. Under Walter model, the firm's internal rate of return means R and its cost of capital K are not constant. Sir, this is false. Why false? Because in that formula of Walter model, immediately after the formula we have written note R and K should be constant. Remember, R and K should be constant. And here the sentence says R and K are not constant. Totally wrong. Totally wrong. False is the answer. False is the answer. Can I continue? 14th B is the answer. Yes, sir. Question 50. What is the formula of Walter's model? Walter's model, P is equal to D plus E minus D into R divided by K whole divided by K. Now looks like option A is the correct formula. D plus, understand, E minus D, they have written this side, anyway it is outside the bracket, R by K. So it is D plus E minus D into R by K. If you do whole divided by K, this is the correct formula. Option A. Option A is the answer. Yes. Question number 16. There is a relationship between firm's internal rate of return and cost of capital. Correct? And what is the relationship? Read option A. If R is greater than K, optimum payout is 0%, equal to K indifferent, less than K 100%. Like this, you have two more options. They've just changed the order of items. Finally, none of the above. So if R is greater than K, logically understand what is the meaning. R is greater than K. Company's rate of return is more than shareholders' expected rate of return, that is K. If company's rate of return is more than shareholders' expected rate of return, company should keep more money with them. Keeping more money means what? More reserve. More reserve means what? less dividend. Correct? That means if R is greater than K, optimum payout ratio should be 0%. Should be 0%. You should pay as less as possible and keep more reserve. Sir, why are you keeping more reserve? Because company has the ability to generate more funds. Company has the ability to generate more funds. Therefore, you should keep money with company itself. Yeah, right, sir. 16. Correct answer is option A. Next, question 17. R is greater than K is a situation for. Now tell me, when will R be greater than K? Only when company is in good position. When shareholders are expecting 12%, but company can earn 15%, 18%, that means company is a growing company. It's not a declining firm. It's not a normal firm. It's a growth firm. Therefore, it is option A. Option A. 17th question. Yes. Question 18. When the rate of return is 8%, capitalization is 10%, then optimum payout ratio is, think, rate of return is only 8%. That means company can earn only 8%, whereas shareholders expected rate is 10%. Sir, we should not keep reserves. It's not a good idea. If you are saying we should not keep reserve, where should the money go? Sir, everything you just pay off. You pay off in the form of dividend. That means payout ratio should be 100%. Are you with me? 100%. Yes, sir. Question 19. When the rate of return and capitalization rate both are 10%, then optimum payout ratio, sir, if both are same, whether you give dividend or keep reserve, it will not make any difference. Correct? When you say it will not make any difference, you are indirectly saying what? It is indifferent. It is indifferent. Yes. Question 20. When the rate of return is 11%, capitalization rate is only 10%. Now observe, your rate of return is higher. R is greater than K. That means company should keep more money with them. If company is keeping more money with them, that means they should be giving very less dividend. Very less dividend means payout ratio should be 0%. Everybody able to get the answers? Yeah, perfect. All of you, if you're getting the correct answers, can I quickly get a thumbs up in chat box? Everyone, I hope you're participating. I don't want you to sit and listen to this session. It will not be of any help. You should participate. You should involve. You have to solve if it is practical. You have to think and send the answer. If it's a theory question, don't just sit. That won't help. Yeah. Good. Let's move on. Question 21. According to Walter's conclusion, the firm should distribute all the earnings in dividend if it has no profitable opportunities to invest. 100% perfect sentence. Read, firm should distribute all the earnings in dividend if they do not have any profitable opportunity. Think about it. A company, they have earned 10 lakh rupee. Company has earned 10 lakh rupee. They are thinking whether to pay dividend or keep reserve. Now, if you're keeping reserve, you should also have an idea what to do with that money. You should invest somewhere. You should use it. Read that line properly. If it has no profitable opportunities to invest, you have earned and you have no good project to invest, then why should you keep money? You should just pay off everything as dividend, give it to shareholders. That's the best idea. Yeah, right, sir. Question 22. Assumptions of approach. No tax differentiation between dividend and capital gain. First of all, believes there is no tax itself. Right, sir. Transaction cost and flotation cost is zero. Correct. That is one of their assumptions. Cost of equity is equal to shareholders' expectation. Right, sir. All of the above. I think that is the correct answer. All these assumptions are true. all these assumptions are true. Yeah. Earlier, when it was old scheme, they used to ask this as a 3 or 4 marks theory question. What question? Explain what is MM assumption, sorry, MM model. List out all the assumptions. Now in MCQ model, what they do? They'll give you 4 assumptions and identify which is a correct assumption, which is a wrong assumption, or maybe all of the above. Correct? That means your subject knowledge that is needed is still the same, but the application of your knowledge will be different. Earlier, you used to write down all the formulas. Now they'll give you the formula. You have to select which is the correct formula. Earlier, you used to write the assumption in your theory question. Now they are giving you all the assumptions. You have to only select. Therefore, don't think just because exam is now in MCQ, it is going to be altogether something else. That's not correct. Your subject understanding is still the same. So your strength, knowing the subject, understanding the concept, that is still useful. Don't think for MCQ, I have to learn something new. It is only that speed we have to improve. It is just that we should practice more and more MCQs. Anyway, from last 3 days, we have already covered more than 100 MCQs. We will be doing 3 more days. Therefore, you will get good number of MCQs to practice. But subject fundamentally is still the same. Correct? So unless you study that basics, those concepts, unless that is clear, whether it is MCQ or descriptive, that won't make any difference. Yeah, right, sir. Question 23. I want you to solve this. Everybody, do it in your notebook. Z Limited has earning of 6 rupee per share, EPS given, having capitalization rate of 10%, KE 10%, and has a return on investment R 20%. Observe, R is 20 and K is 10. R is greater than K. R is greater than K. According to Walter's model, what should be the price per share at 30% payout ratio? I will not solve this. I will wait. You should solve this. I want to see who can give the correct answer. Correct answer is 102. 102. Who got this? I can see few names. Good. 23A is the correct answer. Yes. Perfect. Question 24. 23A is the answer. Option A. This number 102. Yes. Those are not getting the answer, once this live session is over, you can watch this again. Question 23 in dividend topic. You can work out. Yeah. Chalo, 24. The earning per share of a company is 10 rupee. It has IRR of 15%. Capitalization rate is 12.5%. If Walter model is used, what should be the optimum payout ratio? Don't start working out the sum. Read simple. If rate of return is 15% and capitalization rate is 12.5, R is greater than K. If R is greater than K, then sir, what we should do? Sir, don't pay any dividend. Don't pay any dividend meaning what? Payout ratio should be 0%. Reserve ratio should be 100%. Reserve ratio in our textbook, it's called retention ratio. Retention ratio. Yeah. Right. Question 24, option A is the answer. 25. The earning per share of the company is 10 rupee. It has An internal rate of return of 15%, capitalization rate KE 12.5, Walter model is used. What should be the price of the share at 0% payout? Work out. I will wait. Work out this. Everybody, I want you to do this. 0% payout. 0% payout means dividend is 0. That means entire 10 is kept as reserve. So you only have to do 10 into 0.15 by 0.125 whole divided by 0.125. In Calci I got 96 directly. Can you confirm? Is 96 the correct answer? Yes, I can see one by one answers are coming now. Medha, Chetana, Kavya. I don't know what is this person's name. Sneaker Hunk. I'm sure this is not his original name. Sneaker Hunk, is it? Induja, Chaitra, good. Chiru, Sumed. Yes. Many of them are sending answers now. Yes, sir. Good. 26th. Let me start. 25A is the correct answer. 96 rupee. 26. Following figures are collected from the annual report of a company. Net profit 30 lakh. Outstanding 12% preference share. That means you have to pay them dividend. Number of equity shares 3 lakh. Return on investment R 20%. Calculate earning available to equity shareholder. For earning available to equity shareholder from 30 lakh net profit, you have to deduct preference dividend. And how much is preference dividend? 12% on 100 lakh, that means 12 lakh. So from 30 lakh, you have to minus 12 lakh. 30 minus 12. 30 minus 12, what's the number? 18 lakh. Option D. Everybody, are you understanding? Is this correct? Can I continue? Yes. 26D. 27. Following figures are collected from annual report of A Limited. Net profit, outstanding 12% preference share, number of equity shares, return on investment means R. What would be the appropriate or approximate dividend payout ratio so as to keep the share price as 42 rupee? This is a reverse working question. They want share price, final answer to be 42 under Walter model. That means I should write 42 is equal to dividend D, and we don't know how much is dividend. We have to find out. Plus E minus D. Now for E minus D, first I should find out E. E means earning per share. 30 lakh. Out of that 12% or 100 lakh I have to minus, which is 12 lakh. So 30 minus 12, 18 lakh is earning available to equity shareholders. That you divide by number of shares 3 lakh. That means this will be 6 rupee. How much is dividend? I do not know. Are you following? Everybody? To be divided by, sorry, E minus D multiplied by R divided by K. Where is our return on investment? 0.2 divided by K. How much is K? How much is K? KE is not given in the question. KE is not given in the question. Wait a minute. To be divided by KE. Sir, we do not have the details. Yes, I think one information is missing in the question. To do KE, I know EPS is 6 rupee, correct? But divided by price per share is not given. Yeah, I think information K is missing. Yes. I don't want to assume something and do. I'll keep this on hold. In my next session, I will get the correct information. See, even if K is not given, if at least equity share capital amount is given, then also we can do. At least some 100 rupee. See, they have given number of equity shares as 3 lakh. Now, if I take 10 rupee per share, then my answer will be different. If I do 100 rupee, then answer will be different. Correct? Face value is also not there in the question, right? So I'll do one thing. I'll keep this pending. In my next session, I'll get the complete data and then we will complete this question. Okay. So this is pending from my side. I will correct this in my next session. Yeah. 28. Dividend payout ratio is represented by dash. Read option A, option B, which is correct. Who can answer? Go slow. It says dividend payout ratio. Dividend payout ratio means what? How much dividend you'll be paying. Yeah. Before you say, sir, B, what is B? B is retention ratio. If retention ratio is 40%, if retention ratio is 40%, then payout ratio should be 60%. Chetana, go very slow. Question is dividend payout ratio. Understand, if retention is 40%, then payout will be 60%. For me to get 60%, I should do 1 minus retention, 1 minus 0.4. 1 minus 0.4. That means it is option A. I hope no confusion. It's option A. Yes. Question 29. Find out the market price of the share where KE 11%, earning per share 20, R 12%, B is equal to 90%. Go slow. B is 90%. That means you are keeping 90% reserve. Keeping 90% reserve. So how much are you paying? You are paying only 10%. 10% of 20, only 2 rupee. And question is under Gordon model. Remember, Gordon model is E into 1 minus G. Sorry, 1 minus B. E into 1 minus B divided by KE minus G. KE minus G is the final answer coming to 1000 rupee. I will wait. Can somebody confirm? $20 into 1 minus 0.9 whole divided by 0.11. Guys, is it coming to 1000? I can see many of them are sending 20 into, no, not 0.11, actually it is KE minus G. You have to do B into R. 0.9 into R 12%, 0.12. Yes, I think 1000 rupee C is the answer. Yes, sir. Question number 30. Big question. X company has 1 lakh shares outstanding. The current market price of the share is 15 rupee. The company is expecting net profit of 2 lakh during the year, and it belongs to a risk class for which appropriate capitalization rate KE is 20%. The company is considering dividend of 2.5 rupee per share for the current year. Current year dividend will be paid at the end of the year. Yeah. What will be the price of the share at the end of the year if dividend is paid using model? And model, what is the formula? P0 is equal to D1 plus P1 divided by 1 plus KE. D1 plus P1 divided by 1 plus KE. Sorry for my bad handwriting. My handwriting is good. There is some issue with the screen. Yes. Who can answer? What is the final number that you are getting? D1 plus P1 by 1 plus KE. 2.5 plus, sir, we don't know P1, correct? But you at least know P0. P0 first line says current market price is 15. That means you have to put 15 here, left hand side. 15 plus 2.5 plus P1 divided by 1 plus KE. Many are saying option D, none of the above. Yes. None of the above. Yeah. I think you will get answer as somewhere around 14.6. Am I correct? 14.6, 14.6. But that option is not there. Therefore, we should go by none of the above. You're getting 15.5, is it? 15.5. So it is 15 is equal to 2.5 plus P1 divided by 1 plus 0.2. Yeah, I think 15.5 is the correct answer, but that option is not there. So I should go by none of the above. None of the above. Yes. Question 36. Retained earnings are an indication of company's liquidity, are same as cash in bank, not important while determining dividend. It is the cumulative earnings of the company after paying all the dividends. Option D is the correct answer. Option D is the correct answer. Yes, because you create reserves and surplus over a period of time. Last year, last to last year, before that, for years together, you kept creating that reserve. That's why that number is big. Right? That tells you how many years of accumulated profits you have. Yes. With this question, we are done with dividend policy. We have completed how many? 31 questions. No, 36 questions. 36 questions. Perfect. Very good. Everybody. I think last question number was slightly correct. Yeah. It should be 31. Small mistake. 31. Right. With this, we have completed dividend decision topic. Yeah. Let's move on to our next topic, capital structure. Yes. Just give me 1 second before I continue. Guys, before I start, what's your energy level? Can we do this topic today? Or should we keep it for next session? There are about 27, 28 questions. Reply in the chat box, today or tomorrow. Today or tomorrow. Only two options, option A, option B. Today or tomorrow. Okay. Somebody is saying very hungry. Sumedh is saying 100% charged. Many are saying, sir, today we will do at least some questions. Balance we can take tomorrow. I am okay either way. Yeah. Chalo then, let us start. At least 10 MCQs we can do. We all have that much energy. Yes, sir. Chalo, let's start. Good. Question number 1, capital structure. Yes. The optimal capital structure for a company is the one which minimizes firm's cost of capital and increases its value. 100% true. Remember the fundamental formula of this chapter. Value of the firm is equal to its EBIT divided by KO. Able to recall? And if you want to improve the value, you have two options. Either improve your EBIT, profits should improve. If that is not happening, then at least you should try and reduce KO. KO is cost of overall capital. Yeah. Question says the optimal capital structure. Your capital structure should be such that it brings down KO. And if it brings down KO, overall value of the business will increase. Option A, true. 100% true. Yes, sir. Question number 2. Dash means structure or constitution of the capital employed by a firm. It is called capital structure. Option B. Very simple question. Capital structure means the structure or how it is constituted, how the company has constituted its overall capital. Yes, option B is the answer. Question number 3. Capital structure decision is very important managerial decision because it affects risk and return of the shareholders. 100% true. Sir, why are you talking about risk and return? Understand, if company takes too much of debt, what happens? Company will be taking too much of financial risk. And when I say company is taking too much of financial risk, who is affected? The equity shareholders, correct? And if they are affected, their expectation of return will also increase, because when they feel they are in a risky place, they expect extra premium for that risk. And if they start expecting more, company should pay more, correct? Then cost of equity will increase, and if cost of equity increases, then the overall cost KO will also increase. That means it's all about the risk and return. Yes, sir. Question number 4. Go slow and answer. This is confusing. The absence of dash will result in lack of financial leverage. Understand, lack of financial leverage they are saying. That means there is no leverage or there is very less leverage. And first of all, when will you have financial leverage? Only when you have debt in your capital structure. Only when you have debt in your capital structure. That means if there is no debt, then there is no financial leverage. And question says absence of dash will result in lack of financial leverage. Absence of debt will result in lack of financial leverage. If there is no debt, there is no financial risk. If there is no financial risk, there is no financial leverage. Hope you're understanding. Yes, good. Question number 5. The capital structure does not read properly, does not act as a tax management tool. Completely false. Why? Understand, in your capital structure, if you bring in more debt, don't you think you'll be saving a lot of tax? Correct? And how is it not a tax management tool? It is a tax management tool. Correct? It's a false statement. It is a false statement. Next. Question number 6. Interest on borrowings. Borrowing means debt, bank loan, debenture. Interest on borrowing is a tax deductible item. 100% true. 100% true. In fact, why companies borrow is because of this itself. You save a lot of tax if you have debt in your capital structure. Correct? Why will you not go for debt when there is tax benefit? Question number 7. Read this properly. If you go fast, you will go wrong. It says the entire left hand side of the balance sheet, remember your old style balance sheet, left hand side of balance sheet is called financial structure. Answer is true. Many students will do mistake here. Understand, entire left hand side, that means that you are talking about all of this here. This side is asset, this side is your equity portion and liability portion. All of this is financial structure. But sir, our topic name is capital structure. Correct? Financial structure is a bigger thing. In that only long term sources of fund we discuss in capital structure. Short term sources we study in working capital management. So entire left hand side is financial structure. In that, long term portion is capital structure. The short term portion is your working capital. I can see even now in the chat box students are sending wrong answers. I hope you're understanding my sentence properly. Financial structure is entire left hand side of the balance sheet. In that, capital structure is long term source of finance. Our topic name is capital structure. That's why in this topic we only studied equity shares, preference shares, debentures, reserves and surplus. Financial structure is a bigger basket. In that capital structure is long term capital structure, smaller basket. I hope it is clear now. I hope there is no more confusion. Yeah, right, sir. Question number 8. Capital structure is the sum total of all long-term sources of capital. Just now I told you. And in examination, both questions won't come. Anyway, only one question will come. Understand capital structure means what? Sum of total of all long-term sources. Debenture, bond, equity, preference, reserve, surplus, everything. Done, sir. Ninth one. Structure of a company is that part of financial structure that reflects long-term source of capital. Similar sentence, 100% true. Capital structure is a smaller basket in a bigger basket called financial structure. Yes. All right. Easy question. Yes. Question number 10. Yeah. Since we have decided we will be doing 10 questions today, this will be the last question for this session. In my next session, I'll be continuing from 11th one. Okay. Let's do 10th one. Capital structure should involve minimum risk of loss of control of the company. The owners of closely held companies are particularly concerned with dilution of control. 100% true. Now, what is the meaning of dilution of control? Understand, suppose we are only 25 shareholders. 25 shareholders. If we issue new shares to outsiders, then instead of 25, next year we will have 125 people. What happens? Control, ownership will get diluted. Correct? So when you need money, if you are going for equity share, one big problem with equity share is it will dilute the ownership, it will dilute the control. Everybody will feel they are the owners. Correct? Everybody now has a right, has a power. Your company law has given so much power to all the equity shareholders. Earlier, those powers were enjoyed by only 25 people. Now 125 people. That is called dilution of control and ownership. Correct? Answer is true. So these are the 10 questions in capital structure that we have completed in this session. In my next session, I'll be starting from question number 11. And for next session, our target is to complete balance capital structure, and we will be taking working capital management, one of the lengthiest topics in study material. So we will also be spending at least 1 hour 15 minutes on working capital management itself. 15 to 20 minutes will be for balance portion of this topic. All right. Yes, I hope the session was helpful to all of you. We will be meeting once again tomorrow Same time for balance capital structure and working capital management. So if you want to watch next session, please do some revision from your side on working capital management, then you'll be able to participate in this MCQ discussion. All right. Yes. Chalo then. Thank you so much, everybody. Take care. We will meet again. Bye. Bye.